Welcome to Every LA Talks with Los Angeles real estate agent Matthias Baker Mazzucci.
All right, let's talk about cap rates and why that's not the whole story. Look, cap rates get thrown around a lot. People will say like this property has this cap rate, this property has this cap rate, and that's not the whole picture. Why is that so, Ashley?
I mean, cap rate is one factor to consider. It's going to be your cash flow. But for Southern California investors, for example, you buy a coastal property or a property in a core market in Los Angeles, the cap rate only talks about what the cash flow is today. What it doesn't take into factor or what it doesn't take into consideration, for example, is appreciation. You know, you're going to see properties in the Midwest with higher cap rates, but that appreciation isn't going to be there that you're going to get here in Southern California. So it's only one part of the puzzle that you need to look at when you're determining whether or not it's a good investment.
Exactly. And the same thing goes with tax benefits, the same thing goes with debt service. Remember, your cap rate doesn't keep into account your mortgage payments. So that's something to keep in mind. Whenever, you have to look kind of like the whole picture and see exactly what makes sense and what you should do. Because like if you're buying a property, like Ashley said, if you're buying a property in a coastal property, for example, that's, you can settle for a lower cap rate if that's what you choose to do. But if you own that property for 10 years, now the questions is all of a sudden it's changed. Now you've owned it for 10 years, even though, the cap rate is so low, does it still make sense? Because you may have had incredible appreciation, maybe 100% appreciation. So now if the cap rate is still what you settled for, like 3%, should you still keep your money there? Or is it better to move the money around? So just keep that in mind.
Yeah, I think if you're looking at cap rate, you really have to understand the market that you're looking in and understand how cap rate is just a fraction of it. If you want higher cap rates, you need to move out of market. There's different strategies to explore, but don't turn down a property or say yes to a property simply because you see, either a 3 cap or a 7 cap. There's so much more to the story than that.
Absolutely. And let me leave you with a word of warning. Be careful of pro forma cap rates, which are projected cap rate in the imagination, in the world of the imaginary agent or seller that is selling you the property. See, they have a world that has nothing to do with reality where they do the pro forma cap rate. This is what would happen if the tooth fairy would come and would make all your rents to this level, which is never happening. And keep that in mind, that unless you're buying a completely vacant property, which is also pretty risky, depending on the size of the property, the pro forma is never the actual cap rate. So do your own calculations. Work with somebody who could do a rent survey, who could give you the price you can rent per square foot or what is renting in the market and give you an idea of actually what the cap rate would be. Because honestly, anybody can say anything. This pro forma cap rate can be 10% on a property that in reality is 3.5%. Keep that in mind. So there you have it. Thank you for joining us in this video. And if we don't hear from you sooner, we will see you in the next one. Bye.
Thank you for watching. To find out more, visit everyla.com.